Welcome to Money on Tap. Money on Tap, your personal finance headquarters, where we bring out the professionals' experience and some fun in what we call three-dimensional investing, utilizing insurance, brokerage, and fee-based planning. That's what we do on this show. We look at all sides of the issues, and we bring a fully independent planning perspective to the table.
Welcome back. You're listening to Money on Tap. I'm Ben Brayshaw, joined here once again with Dan Michelon. How you doing, Dan?
Doing great. Enjoying spring. Getting ready for summer here.
I'm definitely looking forward to a long, enjoyable summer. Preferably not too much heat and humidity. But we'll see. We'll see. The world has a lot of different moving parts for us these days.
Always surprises in store.
Yeah. I was coaching soccer, and it seems like it's been raining horrendously and cold almost every day we go out on the field with the kids. So kind of interesting. But for you who are interested in wondering, our long-lost partner, Seth Krussman, who is normally with us on the show, he is still recovering. We appreciate your prayers, your thoughts, and he does miss being on with us, and we hope to have him join us here again soon. But he's well on his way to recovery, and that's a good thing, and we'll keep you posted on that. So thank you very much. Today we have a really interesting show. We're going to talk about some of the most powerful metrics in investing. A lot of people in this world they buy stocks because they feel like, hey, so-and-so had mentioned XYZ stock to me, and I really feel like I should just throw some money at it and see what happens.
XYZ is not an actual stock recommendation there, by the way.
Yeah, exactly. So, where do you get your stock tips? And I think we all have that friend. I call it the racetrack theory. It's like your friend who goes to the racetrack. He always tells you about the ones that he won, but he never tells you how much he lost. So your general local neighbor stock tip guy, usually is telling you the advice was long gone before he even knew it most of the time. What do you think, Dan?
Yeah, it's everyone's happy to share the winners, right? But if if that one recommend or that one pick that worked out was from 20 years ago, you better believe there's been a few in between that probably didn't pan out quite so well.
Yeah, and I would tell you that most of the stuff that people actually do in the market, unless it's kind of slow and steady, and that you're really choosing strong, valuable companies that have, really good balance sheets, that understand how to make money, that's really where you should focus on putting your investments, your hard-earned dollars, all of that, versus just throwing it at a whim of, you heard about XYZ. There's a lot of people who, put their money in crazy stuff and made, millions, billions, whatever. And you hear those stories every once in a while. But, I tell you, being in this business as long as we have, Dan, how many people have we heard of that, lost everything in, 2008 and 2009,
Yeah, I think one of the key things to do as, as kind of a novice investor or someone who's, just, having a little fun with some excess cash is to choose a discipline and go with it. I think whether you're using, the kind of tried and true, way to choose a stock based upon it's a company it's a company you like, they have a product you believe in. That's one way to do it. Other people will focus in on specific metrics like we're going to get into today, and they'll use that kind of numeric gauge to make a decision, and they'll focus on companies that fall into a specific range, even if they're not so sure about what they do or what they make. But that's another discipline. It's another way to do it. That's what quantitative analysts do, is they look for numbers. They look for companies that fall within a certain range of a measure, and they invest that way. So that's another way to do it.
Yeah. And I think today our real goal is to, not get really too far into the weeds, but to really bring some awareness to what some of these metrics are, what they mean, and how you can utilize them in your investing strategies. I think this is going to be a very valuable show for a lot of people who want to get kind of past my friend told me about a company and maybe I should put some money in it. And oh goodness, it just went up. Honestly, the second someone tells you about something, it goes up, then you put your money in it and then it goes down.
Yeah.
Right?
Usually we're chasing the news, which is not where you want to be.
Right. So being innovative, trying to figure out if you have real value in front of you, kind of going through those metrics. And we're going to talk about them. We have about 10 of them that we're looking at. We're going to go over a number of them, and if you have questions, we'll do with that. But before we jump into our primary show, we want to get into money in the news. First up today, and our money in the news segment is always interesting because it brings a lot of investing things that are going on. Elon Musk, he's not sure he'll be able to buy Twitter after $43 billion bid, teases a plan B. This is an article by Lauren Feiner, and it's off of CNBC. He has made an offer to buy out Twitter. He owns 9.2% of the stock. He's declined a board seat, which allows him to buy up to 15% of the company legally without having to file. And now he's suggesting that he wanted to take the company public. But that doesn't look like that's what's going to happen.
Last week, the news was we were talking about activist investors, right? So he'd taken a controlling position in the company. He's the largest individual shareholder. And the expectation at that point was that
Trump was going to come back on?
Well, Trump was going to come back on. Elon was going to get on the board. He was going to start kind of getting hands-on with the company and choosing a new direction, perhaps a little less woke. And as of the latest, he's declined the board seat, probably because he doesn't want the SEC requirements that would go with that. He's run afoul of them a couple times before on Twitter. And now he's not the single largest shareholder anymore. Vanguard just outdid him. They're up to 10.3%. Considering that the first tact is maybe not going to pan out, he's gone public with the notion of committing a hostile takeover, buying the shares off the street at higher than what they trade for, and taking the company private again.
Yeah. He's getting a lot of flack for this because back in 2018, he talked about buying all the shares back of Tesla at $420 a share. Didn't quite do that, and that's become a problem for him. So now people are accusing him of trying to do major market manipulation across the board. He does own 9.2% of Twitter.
So his intents are unclear at this point, but he's got something in mind.
He knows what he wants to do, but he throws out all these kind of like other pitches to see how the reactions are and so forth, and then he figures out whether or not he can get to where he wants.
Everything he does and everything he says, the stock's moving up. It hasn't been a great performing stock historically.
No, it has not. I think the number of people, including myself, turned off their Twitter accounts when they started shutting everybody down.
He's beating the drum about, freedom of press and expression and less restriction on who can participate and what he can say, which I think those are all good things.
I think there's all valid points. What did he say? If you don't like the person and they say something you don't like and you can shut them off, then you really don't have freedom of speech. And that's true. Right. So interesting. We'll see what happens. I'm sure we'll be back with Elon another day.
Yeah, stay tuned. Every week, I'm sure.
Oh, gosh, no. Dan, you want to take the next one?
Sure. Up next, our kind of other go-to topic, unfortunately, in this case, is inflation. March inflation breakdown. Where are the rising prices hitting America the hardest? And this is an article from CNN. Oh, excuse me, Fox Business. Well, I can't cross those two.
We need to make sure we're using legitimate sources. Thank you, Dan.
By a Megan Henney. And, theme of the article is much what the title says is inflation continues to grow and continues to be an issue for our economy and all of us trying to live lives and cover costs.
Yeah, and I think the thing is, from the investment side of this, we have to understand that this is the, highest inflation rate we've ever seen, basically.
40 years.
Yeah. So there's very few people have ever endured anything worse than this, and it's hard to say that way, but it hasn't really. I think we see inflation, and for certain people they feel it differently. But I think in the Reagan world, trickle down economics of inflation, I don't think have fully paced with everything that we're purchasing yet, and we're going to see that because people have bids, they have costs, they pre-buy things at stores and so forth, and they have a certain cost. But, as new costs and demand continues to rise, that's going to be interesting. I think we haven't really. I even think the 8.5 is low.
Yeah, it kind of does. The article breaks it down by different sectors of the economy or of the kind of retail purchasing world, and 8.5 is not the highest number on the scale here by any means.
Right.
They point to some other things such as energy, which is up 11% from the previous month and 32% year over year. Specifically, gasoline up 48% from what it was last year. and rising at an 18.3% monthly basis. Although there's been a little downturn at the price at the pump lately, not significant, but I know it was up in the high 430s. Now it's about 410, 415. So
well, I know we killed 3 million birds, chickens in this country or something like that for some illness, and there's a problem with oat production or something like that. I mean, everything that's happening is continuing to add to that kind of hurricane or tornado coming through concept of our financial world. I think for a lot of people from the investment side, this may not be as scary from an investment perspective as people think, though. They're like, oh, with this, this is going to affect pricing and so forth. But there's also an inflationary component in the stock and bond market.
I mean, historically speaking, the best place to go in high inflation is into the equity market.
Yeah.
Which, a lot of the companies there, are able to pass on that cost. So, if it is a company that produces a good who's experiencing raising costs of production, raising costs of employing people, some companies are easier at or more able to pass through that price increase that they're experiencing to the end consumer, than others. And those would be good places to consider being if that's what you think is coming our way, which clearly it is.
Yeah. And I use this example for people all the time. It's like, 40 years ago when IBM was selling computers versus now they're selling computers, it's like they're not the same company financially because of inflation in general. Like the stock has changed, GE has changed, Ford has changed. The valuations, it all is inflationary. So it just takes a little while for the stocks to catch up with that, but it does inflate them as well. And that's something that a lot of people forget, and I think that's why the equity market is a place to go, because it inflates after the inflation. So I think that's interesting. It's something to consider. It's a place that we're going to talk about here in a little bit on our investing strategies and why that's important information to look at. But our last article here I think is going to be really interesting to a lot of people. Unfortunately, it does come from CNN. And this is from Nicole Goodkind. Big changes are coming to your 401k, and here's what you need to know. Now, this is a really interesting article for people who are really looking to figure out how to, be a little bit more robust in their kind of, baby boomer stage of I'm trying to end work well, end retirement strong, get into retirement strong, all of those things. There's a number of different events that are going to happen with this new law that's going to be expected to be passed. But I think one of the most interesting ones of them is that the catch-up provision is expected to go from $6,500 to $10,000 a year. So if you're over 50 years old, you can put an additional $6,500 in currently per year. But it's expected to go to $10,000. That's a big jump of money to put away pre-tax.
Yeah, no, that is a big jump. It's larger than anything we've seen in the past. But, I think a lot of what the article's talking about is different ways in which the government is trying to, stimulate participation in retirement plans. And, we've covered this a lot. And, some of my favorite shows, the No Pension, No Problem series, where we kind of dug into the fact that the employer-provided pension is really non-existent these days. So what do you do in its place? And 401k is kind of the primary go-to resolution there. And this article talks about changes that are relevant there, and I think one of the biggest ones is auto enrollment. So if your employer offers a program and you engage employment there, they're going to automatically sign you up for a 3% withholding. Now you can retroactively cancel that
Right.
They're not going to require you to stay on board and participate if you really choose against it. But what their statistics tell them is that by simply doing it first and getting people signed up automatically, that they're far more likely to participate and just keep doing what they've been doing.
Yeah, and the overall changes are estimated to be basically a $200 billion per year government tax break for people. There's, I look at this and say the people that are getting the biggest tax break are obviously the higher earners. The higher income earners are, getting potentially 37.6% money they're not paying taxes on. Who knows what their state income tax level might be in certain states. But if you're on the lower income earning side, that might only be 10 or 12% that you're actually saving on taxes. So this is really not something that's, specifically really driving kind of the lower income marketplace toward a retirement solution. I would say that this is a Band-Aid where you need a tourniquet.
Yeah, I mean, the article points to the fact that when 401ks were established in the 70s, it was thought to be, part of what they call the three-legged stool, right? So you had Social Security, you were likely to have a pension, and then you had 401k as an elective additional deferral. Well, reality is today and going forward is that pensions basically don't exist. You'd be very lucky to find one. And Social Security by 2030 is supposed to be, basically bankrupt and paying out future retirees 70 cents on the dollar. So the focus on 401k and the need for it and the need to actively participate has changed dramatically. So it certainly is no longer a three-legged stool, down to 1.5 legs.
And I would take it probably even another step further and just say that, for employers offering a pension that they want to have to manage, make sure the returns are there, the investments are handled. I mean, the obligation and the concern of that. I mean, we all know how hard it is to make money in the market. I mean, that's part of life, right? But these companies are trying to run a business, make money, which is another extremely hard task, right? But you're also trying to take care of someone's entire life's need of income. And on top of it, people are living longer and longer and longer. So, I mean, from a sarcastic kind of conspiracy side, I'd say, well, guys, why are we doing these pensions when we're really holding you back from this beautiful 401k where you can go make all the money in the world and gamble on some, big asset and so forth? And then they basically have removed themselves from the pension side because it was an obligatory.
Well, the difference between a defined contribution and a defined benefit, which is kind of jargonish, but it's, in the pension world, the company needs to find a way to pay you an agreed upon amount of money on a monthly basis for the rest of your life. Which is hard to do.
That's a big obligation for.
That's not easy when you get thousands and thousands and thousands of retirees on the books versus a defined contribution, which just means, okay, this is how much we're going to allow you to put away of your own money today, and good luck.
Yeah.
So much easier.
Well, I think about all the resources that financial institutions put together with actuaries to figure out how to create income, and this is what they do for a living, and they don't always do it really well. And then you ask XYZ company to have that burden as well on top of running their business, which is a totally separate domain. I understand it. It makes sense. But the 401k marketplace just doesn't solve retirement income needs. And that's the biggest problem. People don't want to worry about managing their money all the way through retirement. They don't want another job where the day they retire is like, oh, now I got to become a broker.
Well, that's the issue, right? Pension can never go to zero. If you're alive, you get paid. 401k can. You can outspend it.
And that's the thing. People don't know how long they live. So running out of money is a true fear. Well, back to this 401k real quick. A couple of other real changes, which is interesting. I think the payoff of student loan debt while saving, I thought, Dan, was a pretty remarkable difference.
So what they're allowing for here, and it's not a requirement that every company offer this, but the potential would be that rather than deferring your compensation into a retirement plan, you can send it directly to pay down any student obligations you have, any student loans that exist. But what's kind of above and beyond that interesting is that the match that you would usually participate in, the company would still give you the match into your 401k. So, for instance, if you have a 6% match and you're setting aside $1,000 for either retirement or for
your student
loan program, you could pay off $1,000 towards the student loan, but still get a $60 credit in your 401k, which is the match. So I think that's an interesting provision, considering how many people are burdened with significant debt getting out of school, and you face that choice. Well, do I save for retirement or dig out of debt? Now you have kind of the option to do both.
Yeah, they're also talking about moving the RMDs from, which they just moved from 70.5 to 72. They're talking about moving that to 75. Now, I think it's interesting that everything is a delay, right? Put more money away at these lower tax rates, because I really think, Dan, that every time the government might be giving you a tax break today of $200 billion, but I think they're looking at a tax revenue growth of maybe $400 billion on the long term on these dollars.
Although the one thing that's interesting too, though, is they're suggesting cutting the penalty for not taking your RMD, which today is 50%, which is one of the harshest penalties on the books. I mean, that is
on
horrific.
top of paying income tax.
Right, 50% penalty, and then you pay the income tax, which is honestly outrageous. They're going to reduce that from 50 to 25, which is still outrageous.
Yeah,
but only half so.
Only half as outrageous.
Yeah.
Well, hey, listen, you're listening to Money on Tap. We're going to be right back. We're going to be talking about the most powerful metrics in investing, doing value-based investing, understanding how to invest. What do all these metrics mean? What is price per earnings? What's PE? What's earnings per share? Price per sales. I mean, there's so many different ones out there. We're going to talk about them, but we're going to make them in a way that you can utilize them in your own investing as you're dealing with inflation and some of these issues. Don't go anywhere. You can reach us at 855-226-8551, or you can email us at info@yourmoneyontap.com. We'll be right back.
Folks, it is so much fun for us to bring you Money on Tap. My name's Seth Krussman, and I am one of the hosts here at Money on Tap. I'm also a financial planner. That's what we do. That's what Ben and I do. And the fun part is we get to have this radio show. We talk about important things that we think you need to listen to and be aware of to help raise the bar as far as your financial literacy. It's a big part of what we're trying to do here. The other thing that we're doing here as well, as financial planners, we are welcoming you to come and call us and to join us at Brayshaw Financial Group. Experience what complete wealth management looks like. Let's take a look at all sides of the issue, get a three-dimensional perspective, and put a plan around your next step. It's so critical. And so many people just leave this part out and then they find out later, if I only would have known. Hey, don't let that be your story. Give us a call at 855-226-8551 or info@yourmoneyontap.com. If you have $250,000 of investable assets today, our plan is free to you. We think it's important for you to know the facts and have a playbook so you can have a successful retirement. Give us a call at 855-226-8551. Thanks for listening.
Now back to Money on Tap with Ben and Dan.
Welcome back. You're listening to Money on Tap. I'm Ben Brayshaw, and I'm joined here again with Dan Michelon. We're just coming back into our show. We appreciate you hanging around with us. We have a really great show talking about the metrics of investing and the various, 10 to 12 metrics that we look at as relevant and reasonable to consider for various reasons based on different types of stocks. We're not going to be able to dive into all 10 or 12, obviously, today, but we're going to spend some time on probably 6 or 7 of them that have probably more of a more wide range understanding of it. And we're going to dive in exactly to what they mean, how you can actually interpret some of these numbers and utilize them in your own analysis and work as you're trying to figure out companies that are relevant for you. We've done a number of shows on dividend-based investing and value stocks and growth stocks and trying to understand that kind of bigger sector, where to park money. I mean, there's very little yield at the bank. There's low yield in bonds. And those are obviously much safer investments than, going right into stocks or equities, as we call them. But some of the returns and the yields potentially are lower. So, you can't ever compare these things apples to apples, but if a stock didn't move and it's producing a 3% dividend, that's obviously better than a bank CD, giving you a 1% dividend. The difference is that you could lose all your money in the stock. So so now you're saying to yourself, what kind of risk do I want to take? What kind of stocks might I want to own? And how would I evaluate those to figure out if, one, the stock is stable? Does the stock have the likelihood of paying those dividends that it says it's going to pay? I mean, what are those types of different things? And I think it's going to be an interesting show for a lot of people today.
Yeah, I mean, these metrics that we're going to talk about, some of them are looking backwards, some of them are looking forwards, and that's kind of the risk reward scale, the determination we all make, is saying, okay, well, this company's performed well in the past, and I can convince myself of that because I'm looking at these numbers here. Can I project that into future performance, and what's the best tool to use to give yourself the best chance to pick a winner in terms of where the stock price is going to move, from today, the day you buy it, until the day you sell it.
Yeah, and I think we do a lot of value-based investing. I mean, it's probably at our core where we look at investing in assets, and so we look at a lot of these metrics on a regular basis, and probably not to the level of detail on certain types of companies versus others. There's kind of standards where we look at and we say, hey, I really like this. Some of the numbers are really in line, and I have a really good feeling that this stock has opportunity for growth. I mean, at the end of the day, right, we can have all the metrics in the world, but it still could I mean, something can happen, right? I mean, you could have a great windmill company, and all of a sudden a hurricane comes through and tears all the windmills down. Well, now you have an insurance claim. You don't have an energy generating company, right? So there's a lot of mitigating factors that can throw a lot of this stuff off. So the metrics are just really to help build substance behind your opinion that this might be really an opportunity to invest in.
Yeah, and it goes to the heart of qualitative versus quantitative investing. The qualitative analyst or investor, they're the types that like a story. There's a product they believe in, there's a brand that they've followed, and they're going to invest in a company because of the story behind it. Versus the quantitative, that's much more on going through the process that we're going to dive into here a little bit today. They don't care what the story is. They're just looking at the numbers. They're saying, okay, numerically, mathematically speaking, they've done this before. I can project that they'll do it again. And they select their portfolios based on that alone.
Yeah, I think that's a great point. As we kind of dig through, the comparable difference between qualitative and quantitative, and working through the numbers on the quantitative side, really good balance in the conversation we're having here is, formulate your opinion on the company and back it with that quantitative analysis.
Yeah, that's a great way to do it. Is pick the stories you like, and then dive into the numbers after that and say, okay, I like the story and there's a reasonable basis supported by these facts and figures that tells me this is going to be the pick for going forward. Agreed.
Well, so, the first item, and probably one of the most common things that people talk about, at least on our side. So we know that 99% of our investors aren't going to know at least 6 of the 7 or 7 of the 7 different items that we're going to talk about today. But probably one of the most common ones that people reference in the financial world about a stock and looking at the numbers is the PE ratio. Dan, you want to talk a little bit about that?
Yeah, price to earnings. It is definitely probably the most commonly discussed. And if you're watching any of the the TV commentators or you're listening to the stuff on the radio, what they're talking about there is high multiple companies. You'll hear that terminology for it too.
Yeah.
And what they're really doing is the math of it's pretty simple, and you can find these things out there in the public. These are some of the numbers that publicly traded companies are required to disclose, so it's readily available. But you're simply taking the price of the stock and dividing it by the earnings per share.
Right.
And it's a good way to come up with a number that you can then compare to other stocks or the market as a whole. And we pulled up some numbers that I thought were pretty interesting about kind of the major market indexes, as of close yesterday, where they stood. And the price to earnings ratio, or the PE, which we'll refer to it as, for the entire S&P 500 was 22.2.
And I think that's interesting. So 22, let's just use 22 as the PE of the S&P 500. Okay, so we're at 22. So, how do you detail whether or not you have a good PE or not? And I think that's interesting because there's 3 ways of looking at almost every one of these statistics we're going to talk about. So the confusing piece that people have out there is they talk about the PE, and then you'll hear trailing, or you'll hear forward, or you'll hear mixed. And those 3 different scenarios are looking at either the trailing side of all the numbers, okay, and they're doing the PE ratio number off of that, or forward is looking at the earnings per share, all of that stuff moving forward and what their earnings are going to look like and projected to look like. And then you have this mix, which makes sense, right? You're going to look at the last 6 months and the next 6 months, what it was, what it's projected to be. And a lot of people, reference one or the other. I think that's an interesting piece.
Yeah, I think we should take one quick step back here and say, well, okay, so there's a number there. What does that mean, and how does it compare? What that's saying, this PE of 22, all right, is saying that, if you believe that the market's efficient, which that's the underpinning of a lot of investors and a lot of...
Well, let's explain.
Yeah, well, that's probably another can we just opened there, right? So what that's essentially saying is that the market averages itself out, right? So if a company has a higher PE than what the market does as an average, which is 22 in this instance right now, that company's potentially overvalued. And if the PE is below the market, so something below 22, it's potentially undervalued.
Right.
That's a very simplistic way to go about it, but that is what is essentially is the meaning behind the numbers.
Right. The idea of efficient meaning that, hey, listen, everything's working together, everything's priced out the way it should be and so forth. And then there's going to be these outliers.
Yeah, some companies are overvalued always. Some companies are undervalued always. But the top 505 companies averaged out should represent their actual value.
Right. Exactly. And so using the idea that the overall picture is efficient, that it's true to what kind of the math should be, and there's a lot of people that fall on one side of the inefficient or efficient, and we're not going to debate that scenario today, but the concept that, hey, listen, there's different types of PEs for different types of indexes or different types of domains of investing. So I think that's what's really interesting, because when you actually look at like the Dow, which is the 30 largest stocks in the United States, what was that data? It was a little over 7, right?
Yeah, 7.82, just about 8.
So about 8. The S&P 500 is 22. So the lower the PE, theoretically, the better potential investment. But you have to look at it compared to its peers. Right, so Apple's going to have one PE, and then the GE or Dow or Johnson and Johnson or whatever they're going to have different levels of PE. So for the tech side, I think it's interesting. Dan, what was the Nasdaq? Which is
25.
25, which is not too far off from the S&P.
Yeah, I was surprised to hear that, honestly.
I was actually a little surprised as well. But in reality, there's just so much tech, I think, now, because everything – what is a tech stock?
The tech is the S&P almost.
Right? So it's not – it's not as surprising, but I usually look for tech stocks under a 25. That's usually what I look for. I'm usually looking for kind of a value-based stock somewhere under 10. 12 or 10.
And the trick to it, too, is we're kind of focused in on value investing, which is a lot of what we do as we're generally trying to produce income for people. But if you're a growth investor and you're listening to the show, you might say, okay, well, I got these couple of growth stocks in mind. Let me go check them out. And you're going to find that they don't have a PE because they don't have earnings.
Yeah.
It doesn't mean it's a bad investment, but what it does tell you is that this company, at whatever price it is per share, has yet to turn a profit.
Yeah. And that's
that's high risk territory.
Yeah, exactly. So we're going to focus on profitable companies today, and work through that. So PE is probably the most common, lingo in our world of trying to figure out whether or not there's a company that's either undervalued or overvalued. And I think that's a really good, important factor for a lot of people to learn. So if you're not familiar with PE, I would highly encourage you to really engage here. This is the one metric that I would say holds the most importance to me.
I'd agree, yeah.
Okay. So number 2, we have price to book value ratio, okay? Price to book value ratio compares the price of the stock to the current book value of the company. So it's the total value of the company's assets minus any liabilities. So it's on a per share basis. So this is a really interesting one, and I think that a lot of people I would say that I don't give this as much credence as I should. Actually going through some of the stuff that we're talking about, what we're going to do on the show, is like, I probably should look at this one a little more often. But when you start determining, the value of a company on a per share basis, you got to divide the total net assets on the company. And you start digging through all this stuff, and what happens is the example I have here for you is, let's say a stock, the price of a stock is $50. To determine the PB ratio, the price to book, you would divide the $50 stock by $10 per book value per share, coming up with a PB ratio of 5. If you have that 5 and you realize that the average PB ratio in the tech space is about 19, it suggests that 5 is significantly an undervalued stock in the tech space. And I think that's really where, when you look at the PB ratio, you just want to compare to its peers, look where the sector's at, and then the lower your PB ratio is, the better off you are in an undervalued scenario.
Yeah, I think what the indicator that this particular metric is looking at, the probably the more important part for me when I consider that, is the debt, right? How much debt does the company take on, or how much do they presently hold to turn whatever kind of profit it is that they are? And it's not necessarily a bad thing. It's just something to be aware of, right? A younger company is very likely to be in significantly more debt than a mature company, right?
Right, absolutely. The third one we're going to jump into here is price to sales ratio. I think this is something that, kind of makes a lot of sense. What's the price of the stock compared to its sales?
Yeah.
When you really break it down, you really want to know, hey, how much are you selling? How does that compare to my stock price? And is this reasonably undervalued enough that I want to get into that stock? I think that's a good stop. Do you want to take that one?
Yeah, I think this is the more forward-looking of all of them, right? So what you're doing is you're simply taking the price of the stock and dividing it by its sales. So that's going to give you an indication that it's discounting or not really factoring into the present state of debt that the company might hold.
Right.
So you're assuming, if this is a metric that you use, you're looking at this as a company that is just going to continue to earn, again, you'd be comparing the price to sales against its peers and its industry. So if they have the better number there and you're willing to invest in that, then your belief is that this company is just going to outsell its competition. It will be able to cover the liabilities over time simply because of that strong sales growth. And, that is nothing wrong with that rationale at all.
No, absolutely. I think if you're looking at a price to sales ratio over 2, buyer beware. I mean, you really want something that's, even under 1 would be like ideal. But between 1 and 2 is kind of a question mark. Yeah.
I mean, it's sometimes with these growth companies, and we've gone through, huge cycles of this, particularly right after the pandemic, there was so much cash out there in the market that anybody that had a hint of sales potential, you saw the stock price just absolutely skyrocketing. It went through the meme stocks, of course, and then, the Zooms and the pandemic stocks. And these stocks the price was just so driven up by the fervor of the market and the enthusiasm and all that cash out there that, it really left all their earnings and other metrics in the dust. It was really just a speculative play, and there was a lot of emotion in that. So that's where I think these metrics that we're talking about today, and we'll dive into a few more, really are things to look at to kind of really bring it back down to earth potentially. Yeah, and we're going to take a quick break here, and I want to encourage people to stick with us. There is a silver lining to the amount of quantitative discussion we're having here, but it's really, really important because, as value-based investing becomes much more on the front lines, I would say. I mean, we've been heavy value-based investors for a long time, but as it becomes kind of a more common, more aware thing, especially as the market's seeing a lot of turmoil, people flock to value-based investing. You want to make sure you're choosing really strong stocks. We have a couple more that I think are really, really valuable. So stick with us. You can reach us at 855-226-8551. And you can also email us at info@yourmoneyontap.com. We're coming back. We're going to talk a little bit about some other ratios and some comparative analysis that we can work through and try to break this down for you. Thanks so much for listening. We'll take a quick break.
For a number of our listeners, they have a lot of questions, and you might be one of them. Today, we're just offering what we call Zoominars, webinars over Zoom meeting rooms where we have top experts, Social Security, estate planning, and financial planning experts for you to speak with, do a private consultation that way today. We're also having webinar-based Zoominars where we're going to have multiple groups where you can be part of that and enjoy that as well. Give us a call at 855-226-8551 or email us at info@yourmoneyontap.com to schedule your Zoominar.
Now back to Money on Tap with Ben and Dan.
Welcome back. You're listening to Money on Tap. I'm Ben Brayshaw here with Dan Michelon. We are talking about the metric investments that the metrics and the investments we utilize. We're obviously not covering all of them, but we're trying to really break this down into something that you can take a number of these away with you to utilize. And I would encourage people, go to Yahoo Finance and, look at some of these various metrics we're referencing, play back our show and kind of walk through them and get an idea of some of the assets you hold. Also, if you're curious about the risk in which some of your assets are, on our website we have a risk profile where you can type in all the different assets you have, and will give you a risk score. The risk analysis is totally free. It's something that I think is so underutilized, and something that might tell you the kind of risk you're carrying around each and every day that no one even knows. I mean, it's amazing. We had a show on that a while ago on understanding risk, and people really just don't understand it. And these metrics are the core to evaluating risk.
Yeah, that's a very useful tool, and it's something that that we use internally all the time. When someone comes to us with a portfolio and some investments that they've had and held, we'll often use that to compare, three values really: the risk analysis of our portfolios that we offer, the risk analysis of the portfolio they presently hold, and what the risk analysis of their actual personal risk tolerance. Right. So everyone individually has a score that we can come up with through asking a series of questions. And what we'll often find is that, the risk somebody actually holds in their present portfolio is either way too high or way too low, and that we can, take those same assets and construct a portfolio for you that's much more closer to what your actual true risk tolerance is.
It's actually shocking.
Yeah.
I mean, it's almost, for some people, they're almost scared. They have no idea.
It's an eye opener no matter what. I mean, the one thing that doesn't often happen is you find somebody who's actually right on with their risk tolerances. That's the one outcome that you don't find.
Yeah, that's. I have to say I have had one of those.
You had one?
Yeah, I had one. I did have one, but it was luck. But anyways, so one of the first ones we talked about was the PE ratio, right, Dan, and price per earnings per share, and. It's probably one of the most go-to metrics out there. But the problem is it doesn't really create the level playing field that, to compare stock 1 to stock 2 when you're really trying to figure out what does the future look like. And I think that's one of the pieces that's really missing, because you can have a great price per earnings number. You could have a multiple. We talked about the Dow being at 7.6. We talked about the S&P being about 22 on a PE scale. And obviously the S&P 500 is the 505 largest companies in the United States, where the Dow is a selective 30 largest, and so it's obviously the S&P is a much broader range, and when you're kind of digging through the PE, you could find a company that has a great PE, but its PEG ratio, or price per earnings to growth ratio, is not quite as good.
I mean, there's a couple things about that I just want to jump in and say. So PE ratio is very much a here in the moment measure, right? So that's how is the company doing today. That's less of a predictor of what it's going to do tomorrow, right? So that's a good number to look at to give yourself kind of a present checkup on any of the investments you hold. But if you're more so looking for a predictor of where it's going to go from here, there's some of these other metrics are probably a little bit more valuable there. And this one in particular, I think, is valuable looking at that because it's taken into account the expected future growth. But what's important to do here, I think, is if you're going to use this as an analytic tool, make sure you're comparing it to its other peers in its specific sector, right? So the PEG value of a company versus the S&P as a whole is probably not tremendously valuable. You really do want to confine that to the sector that you're in.
No, absolutely. Absolutely. And I think, when you're looking at, the PEG ratio, I mean, you can really find, what you really discover is the fact of whether or not the company is expected to really be much stronger later on. And against a peer, you can see how it's going to look comparatively. Like, you could have peer to peer, stock A might have a really, really low PE, like a 5, and then stock B might have a PE of a 10, but then you look at its PEG ratio, and all of a sudden it flip-flops. because the really low PE doesn't expect to have great earnings, and the forward looking doesn't look so great. And so to have that kind of forward projection on that piece is really, really important. PEG ratio is probably one of the most appreciated metrics, I would say, by the quantitative marketplace, right? I mean, it's the one pretty much everyone go. The PE is the basic, like, hey, where's its PE? Okay, now let me dive in. That's kind of how people do it, right?
Yeah, that's a good tool to filter out with, but maybe not make a buy on.
Exactly. So number 4. I'm sorry, number 4. Number number
5.
5.
Yeah, close enough.
Number 5. Debt to equity ratio. And I think this is kind of a really simple one, right? I mean, we talk about personal debt all the time. We talk about, what are you worth, right? How much do you have in the bank and how much is your debt, right?
It's a net worth analysis, really, right?
Let's just break it down. So obviously, low debt is a really good one. So a lot of companies, this is an issue because they sometimes carry high debt. And you made the point earlier where they're generating cash flow ultimately to offset those debt payments, and their equity is not that big.
Yeah, I mean, and I'm entirely guessing at this, but we've talked a little bit, not so much lately, but there was a time where all these space stocks got real hot, right?
Yeah.
Because all that cash was out there in the marketplace and people getting really speculative. I'm going to guess that the debt to equity in the space industry is probably not great because they haven't put anything up there they can sell yet. They're still building the rockets and going through the research and development and looking for investors to fund these future endeavors that may turn up a huge profit someday, but they're nowhere even close to there yet.
Well, and with the doubling of the price of fuel, that might limit the space travel too. I don't know. I'm just speculating there. Haven't seen much on that. But as we break into number 6, which is the free cash flow analysis, I find this to be really, really important because there's a couple different moving parts that's relevant to free cash flow, and I think free cash flow speaks to itself. It's the amount of cash after paying all your bills, essentially. It's important to know that you have free cash flow because then you can determine whether dividend yields are likely to be paid, whether what the future looks like of being able to continue paying those things. So as free cash flow starts to dwindle, companies get really tighter and tighter and tighter, and that's a concern.
Yeah, and especially in an inflationary period like we're in, right? Companies face some of the same issues that we do in that, the cost of money is getting more expensive. I just saw mortgage rates hit 5% again for the first time in 20 years or some stat. So free cash flow for a company means that, if they can, number one, pay a dividend with it, which we just spoke to, and we track those companies a lot. But they can also reinvest in themselves. They can make hires, and they can do it without having to add the weight of the cost of money to their balance sheet, right? So they don't have to borrow somebody else's money. They have their own.
Yeah. Free cash flow is a really important item. It needs to be, when you're looking at the metrics, obviously you want it to be a positive number because, negative free cash flow means you don't have free cash flow.
You're not turning a profit.
You're not turning a profit. So those are really, really important things because you can find companies with, all sorts of different really strong metrics and then find out that their cash flow is going negative because of something. And honestly, if you see companies that have, positive cash flow, then they have negative cash flow, then you're looking at like unstable companies, right? They're kind of going back and forth, and then you wonder about their long-term ability to continue to turn profits. And I think, Dan, you're going to find a company that might have pulled back with unstable cash flow, right? But is it Acme, whatever that whatever product that they're selling, is it something that's just starting to get noticed? Is it something that's really building an opportunity, or is it something that no one can care about?
Yeah, it's again that probably plays into the sector you're looking at, right? And how important is that? If you're an innovative sector, if you're in phones or spaceships or something the higher end in the technology, that matters because they need to invest in the next thing. They have to, or else they're going to die competitively. Right. But if you're a utility company or somebody who's doing the same thing you always have done and always will do, well, that's a different story.
Yeah, absolutely. I think that's one of the things that's hard because you have to look at there's companies that will have really great cash flow for a very, very long time, and all of a sudden, they're just innovated out of the market, and they didn't innovate, into the next market. And it's a point in time when to know get out of a company.
Yeah, when the cell phone era was exploding, Apple was always there, but you had your Nokias, your Blackberries. I mean, what kind of list went on and on. What happened to those guys? They didn't use their cash flow right.
That's for sure. You're listening to Money on Tap. I'm Ben Brayshaw here with Dan Michelon. Thanks for joining us today. We really appreciate having each one of you, and we appreciate all the communication back and forth and the people who have come in. And it's just been interesting to meet a lot of our listeners, and we encourage you to reach out to us. You can reach us at 855-226-8551 or email us at info@yourmoneyontap.com, because it's all about your money, and that's what it is. We're talking about the most powerful stock investing metrics out there, and there's a lot of them out there, and we're talking about basically 7 today. And as we wrap up this show today, I think there's basically a 7th that I would say pair together very quickly, which is the beta and the alpha. And beta and alpha are obviously 2 Greek letters that we use very very regularly in here. But beta is the measure of risk. Alpha is the ability to see profit through its peers or against its peers. And there are 2 different ratings to evaluate. As we jump into beta, Dan, really very simply, I mean, probably the easiest way for our listeners to evaluate is to think of beta or the standardization of beta as a 1. Okay, so anything below 1 is lower risk to that sector or market or investment, and anything above 1 is, you're taking more risk than you need to probably in that investment.
Yeah, it's a gauge of kind of volatility and performance, right?
Yeah.
Something with a low beta is likely to maintain a stable price in different market conditions, and something with a high beta is obviously more speculative. So it behaves in a way that's, historically speaking, swings bigger than the market itself does.
Right.
And so that's a key metric. And we try and build a portfolio using the full spectrum of 3D investing, right, so that we can use the gamut of investment products out there to bring someone's overall risk factor somewhere below 1 is generally what we're looking to do.
Yeah. And I think the thing is that we look at all these different pieces, but we also have the ability to add that, qualitative component, right? To look at something. I mean, we had this just last month. We owned a few big tech stocks that we bought in the beginning of March, and we had a very quick rise in some of the tech recovery. We saw 3 very big companies as really good buys, and we actually made a very good qualitative decision and decided to liquidate one of those. Yeah. And it worked out to our favor. So sometimes, I mean, unfortunately, we have to pay taxes on some of those gains, but there is that qualitative event. We've talked about all these various metrics that drive that. Alpha being the other piece to the beta, and just trying to have a positive alpha so that you're saying to yourself, I'm making more. When you have that percentage of positive alpha, I'm doing better than that comparative.
I'd even go so far as to say we bought in using quantitative analysis and sold out using qualitative because we saw the PE of these tech companies because the price per share came down and the earnings were the same. So we said, well, there's a buy signal there. And then the qualitative analysis is just saying, well, hey, there's a gain here. Take it, right? I mean, that's the simplest stories you can find right there.
Yeah, you put that money in there, there's nothing wrong with taking a profit.
Never.
And I always tell people, you're never going to buy at the low. You're never going to sell at the high. It just doesn't exist. Those are created by massive investment moments that happen that send things to a peak because someone's buying, and then when someone's selling. And you just hope to be as close to one of those as you possibly can. But never regret selling anything.
If you took a gain.
Well, you could have taken a bigger loss.
That's true.
Yeah. So the alpha, I mean, I think when you're looking at beta, you want to really make sure that beta is really low, get your risk low, get that profile low, and then you want to compare it to the alpha. The alpha is, the ability of how much money you're making above and beyond its peers, that percent. You don't want to be like 3, 4, 5%. That would be amazing to have an alpha that's that high compared to its peers.
Absolutely.
So, hey, thanks for joining us today. We appreciate we're running out of time here. You're listening to Money on Tap. So happy to have you today. We hope you enjoyed our show. You can reach us at 855-226-8551 or email us at info@yourmoneyontap.com. If you have questions about today's show, you'd like to get more information on some of the quantitative work and these metrics that we talk about, or want some more information, call us about our white paper. Be happy to share that with you. Thanks so much, and you make it a great week.
The views expressed are not necessarily the opinion of this radio station and should not be construed directly or indirectly as an offer to buy or sell any securities mentioned herein. Investing is subject to risks, including loss of principal invested. No strategy, product, material, or tool mentioned can assure a profit nor protect against loss. Please note that individual situations can vary. Therefore, the information, products, materials, or tools mentioned should be relied upon when coordinated with individual professional advice. Past performance is not a guarantee of future results. This show may be subsidized in whole or in part by a product sponsor or issuer. Securities and advisory services offered through SagePoint Financial Incorporated, member FINRA SIPC, and a registered investment advisor. All other services offered through Brayshaw Financial Group LLC are independent of SagePoint Financial. SagePoint Financial and Brayshaw Financial Group do not provide tax or legal advice. Main office is located at 116 South River Road, Bedford, New Hampshire, 03110, and can be reached at toll-free 855-226-8551.